Can we continue? Let's start with the practical questions on AS2. Question 6. Rohan Private Limited is a wholesaler in agricultural products and has valued inventory on net realizable value on the ground that AS2 does not apply to inventory of agricultural products. True or false? Is AS2 applicable to agricultural products? AS2 is applicable to a trader of agricultural products and not a manufacturer or producer of agricultural products. So we have to write as per AS2, valuation of inventories, the standard applies for a trader in agricultural products. Wholesaler is a trader here, yes, so the standard will be applicable to him. Okay. So let's check the answer. AS2 does not apply to producers of agricultural products, but applies to traders in agricultural products. Therefore, AS2 will apply to Rohan Private Limited and it will have to value the inventory at lower of cost or market value. Sorry, cost or net realizable value. The actual word will be net realizable value. Question number 7. This is a inventory valuation based question. On the basis of the given information, find the value as per AS2 to be considered while preparing the balance sheet as on 31st March 2021 on weighted average basis. So we are going to calculate the weighted average cost of inventory, okay, and hence calculate the net realizable value. So how do we calculate the weighted average cost of inventory? So we are going to start with the date, receipts, issues, closing stock. Okay. Purchase rate, purchase value, and total value, total weighted average rate. The format, you can have different formats. If you are following different formats, doesn't matter. Okay, the point is you have to just understand how the valuation is made here. So we start with 1/3/2021, I have purchased 20 units at 108 rupees. So 20 units in the receipts column. Issues nil. Therefore, my total closing stock will be 20 units. Purchase rate is 108 rupees per unit. So 108. And hence the purchase cost is 108 into 20, which is 2160. So total value of inventory is same 2160. Now total weighted average is going to be 2160 divided by closing stock units. 2160 divided by closing stock units, so which is again 108. Okay. Next. On third, we have issue of 10 units. Go in the chronological order. Third, we have an issue of 10 units, which gives us a closing stock of 10. There is no purchase. So purchase columns, let's put it as nil. Now, what is the value that is remaining in hand? Out of 20 units, 10 units are gone. So 10 units into 108 rupees, which is 1080. So 108 is the weighted average rate. Right? So far simple, only one purchase, one rate. Next, 8th March. 8th March, 15 units at 107 rupees per unit. So 8th March, 15 units. So if 15 units are added, so the total closing stock now becomes 25 I believe. 10 plus 15, which is 25 at 107 rupees, right? So 107 rupees. What is the purchase value? 15 into 107. 1605. Now what is the weighted average? 26, which is nothing but 1605 plus 1080. Correct? 2685. So 2685 is the total value for 25 units. One or 7 point. Is this correct? Is this correct as per AS2? This was one of your again previous tested questions only. Listen here. Now this is where you need to understand. There is a small point that you need to remember. AS2 says weighted average will consider cost of opening stock plus cost of purchases. It does not consider cost of issues. Here we are subtracting cost of issues. 1080 is arrived after subtracting cost of issues. This is not to be done as per AS2. This is what we normally do. AS2, this is not allowed. If you do this, you will end up getting a different answer, which will not be AS2 method of valuation. AS2, the rule is very simple. Cost of opening stock. Here no opening stock. Cost of purchases. Cost of issues is not at all a point of consideration under AS2. So now what do I do? We are going to change our answer here. Please note. Okay, I am changing this part. Your valuation of inventory under second line, which is as on 3rd March, put it nil or not applicable. Leave it there. Do not do anything to it. Now, when you come to 8th March, what is your total purchase value? I have purchased 2160 for 2160 rupees on 1st March and for 1605 on 8th March. Total 3765. Now 3765 is for how many units purchased? 20 plus 15. 20 on 1st March, 15 on 8th March. So totally how many units? 30. Sorry, 20 plus 15 is 35. So 3765 divided by 35. What is the rate? Small difference? It will make a final difference answer. So 107.57 will be your weighted average rate as on 8th March. Not 107.4 which we earlier calculated. So remember the rule of AS2. AS2 we are only worried about cost of purchases, not about the cost of issues. In FIFO we will not have this problem. First in, first out. Weighted average alone we will have this issue. Okay. Next. In the same line, let us continue. Next, what is the purchase rate? Date, I think 12th March we have an issue. So 12th March, issue of how many units? 20 units. So what is the closing unit? 5. Purchase column put it as nil, value also put it as nil because for us it is not relevant for this calculation. Next, 17th March purchase of 30 units. So now my closing stock increases to 35. Purchased at 109 rupees per unit. So 109 into 35 gives you 3815. Yes. We are not valuing the cost of issue here. We are valuing the cost of inventory. So on 8th March, cost of inventory is 107.57. Yes. Okay. For us, in costing, when we do, we will value the cost of issues. Okay. AS2 principle is only inventory valuation, not production valuation. AS2 only speaks about closing stock. So now go ahead. Now here we are going to listen, do the calculation as 3765 being your total value till the previous purchase plus additional 3815 for the current purchase. Total 7497. Okay, 90. 7490 is for how many units? 35 plus 30 units, so 65 units. So 7490 divided by 60 units, giving you 65 units, my bad. 65 units, giving you, okay. Okay, let us recheck the numbers. Okay, I have taken the numbers based on what you told me. Let us recheck the numbers again. 1 minute, let us recheck. 109 is the purchase rate. 30 units purchased. So what is the purchase value? 30 into 109. Have you given me 30 into 109? Kudukala. Appo maathirla number. So what is the answer? Okay. 3 to? Repeating again. 109 into 30. Got it? So now 109 into 30 is 3270 plus 3765 will give you 70 70. Okay. Now 7035 divided by total number of units purchased is 65, which is 108.23. So we are only totaling the cost of purchases. We are not doing any other thing here. Complete the question, balance of the question. Please complete the question and come to the last point. We will check your answers at that stage. Go ahead. I hope the logic is clear. We are only going to take the cost of purchases and not the cost of issues. You can. Not required. Now I showed this only to make you understand the difference of what we do in the bin card method or the previous method. And so if in the exam you can just total all purchases divided by total units. Directly you can calculate it. If it is FIFO, you have to do it in this order only. First in come, first out order only. And in FIFO, you will not have any difference because you will anyway take the value of the inventory based on the purchase rate. Please complete the working for the balance periods and then let us check the answer. One not 8 exactly. Let's check. 108, yes. 108 should be your last 25th March. The final weighted cost that you get will be 108 rupees. So now coming to the rule of inventory valuation. I hope you are all getting 108 rupees, my dear friends. Okay. Now coming to the rule of inventory valuation, closing stock is valued at cost or NRV, whichever is lower. Now if I take the cost, it is 108 rupees into closing stock of 20 units. I think in the last line you would have got a closing stock of 20 units. So 108 rupees into closing stock of 20 units, which gives you 2160. Let us see what is the NRV as per the question. The net realizable value is 107.75 per unit. So 20 units into 107.75 will give you 2155. So whichever is less, what is the value? 2155 will be the cost of the inventory value as per AS2. Friends, for the same question, if you do it after considering cost of issues, exact answer will change. Answer you will get less than NRV. So you will end up valuing it at cost. Answer appadiye maridum. So remember the rule as per AS2. We are only here doing AS2 valuation. So for us, only cost of purchases is relevant. This will be your final answer. 2160 cost, NRV 2155. Therefore, value it at NRV, which is 2155. I hope the valuation is clear. For presentation, as someone was asking, not required to show the issue of stock. It is enough if you show only the purchases. Like she was also asking, it is enough if you show the purchases alone. You need not show the issues column also. Under weighted average. Whereas if it is under FIFO, then you have to do the entire table. Okay. So this is question number 7 for you. Answer 2155. Can we move on to the next? Question number 8. In a production process, the normal wastage is 5% of input. 5,000 metric ton of input was put in the process, resulting in 300 metric ton of wastage. The cost per metric ton of input is 1,000 rupees. The entire quantity of waste is on stock at the end of the year. How will you value the inventory in this case? So what is this wastage relating to? Normal loss and abnormal loss. So we need to calculate the value of inventory considering the normal loss and also calculate the value of abnormal loss separately. Let us do the working. So total cost of production is 5,000 metric ton of input into 1,000 rupees per unit. So 5,000 into 1,000, which is rupees 50 lakhs. Too many zeros. Be careful in putting your zeros. Right? 50 lakhs. Next, 300 metric ton of wastage. So, first before that, let us calculate normal loss, which is 5,000 into 5%. 250 metric tons. 250 metric tons. So therefore, what is your abnormal loss? 300 minus 250, which is 50 metric tons is your abnormal loss. Now coming to the cost of inventory per metric ton. 50 lakhs divided by 1000 units, sorry, 5000 units minus 250, which is 50 lakhs divided by 4750 units. 1052.63. Always please take decimals up to 2 decimal places for accuracy. 1052.63. So what is your cost of abnormal loss? 1052.63 into 50 rupees. 52 631.57 or 51.57. Yeah. So this is your calculation. Like I told you, writing the answer with the provisions is important. So let us see the answers for the provisions part also. As per AS2, abnormal amount of wasted materials, other labor and production costs are excluded from the cost of inventories. You can say abnormal loss is excluded from the cost of inventories. And such costs are recognized as expenses in the period in which they are incurred. In this case, normal waste is 250 metric ton, abnormal waste is 50 metric ton. Therefore, the cost of 250 metric ton will be included in determining the cost of inventories, and then comes your calculation. Okay. So cost of abnormal waste is 50 metric ton into 1052.63. That is what we calculated, which is 52,631.57 or 52,632. Charge to profit and loss. And the value of total inventory will be 4,700 units because 5,000 units is input, 300 fully lost. So 5,000 minus 300, 4,700 into 1,052.63, which gives you 49,47,368 rupees. Is this clear? Can we continue? Question number 9. Question based on NRV calculation. On 31st March, a business finds that the cost of a partly finished unit, which is a WIP, is rupees 530, which can be finished in 2017-18 with an additional expenditure of rupees 310. And the finished product can be sold for 750 subject to a payment of 4% brokerage on the selling price. The firm seeks your advice on the amount at which the unfinished unit should be valued as on 31st March for preparation of final accounts. So what is given here? Cost. What else is given here? Estimated selling price of finished goods. So what we need to find? We need to find the NRV. And then we will conclude cost or NRV, whichever is lower. So let's go ahead with the calculation. So cost of WIP 530. Cost of, okay, selling price of finished goods 750. Now NRV, what is the formula? It is nothing but estimated selling price of finished goods minus cost of completion, because this is a WIP unit. So minus completion cost minus selling expenses. So now 750 is the selling price. Completion cost, additional cost of 310. So minus 310 minus selling expenses is 4% on selling price, which is 750 into 4%. 30, huh? Yeah. So 750 minus 310 minus 30 gives you 410. Now, this is calculation part. What is the standard provision that we are going to write? As per AS2, inventories are to be valued at cost or NRV, whichever is lower. In the given case, cost is 530 rupees. In NRV, how to calculate NRV? We will write NRV is calculated as estimated selling price of the finished goods minus cost of completion minus selling expenses. Okay? And then we conclude our answer saying we need to calculate it at NRV because the same is less. So your answer is valued at NRV, which is 410 rupees per unit. Remember to write the provision of AS2. As per AS2, inventories are to be valued at cost or NRV, whichever is less. So this is valuation of inventory at NRV, 410 rupees. Got it? Okay. And this summarizes our discussion on AS2. Any doubts with respect to AS2? A quick 2 minute for you to run through and assimilate once, and then we go on to the next standard. Okay, to the question that someone has asked online, in question number 8, it is stated that the entire quantity of waste is on stock at the year end. Waste is not a value of, waste is like scrap. So scrap cannot be valued as inventory. That is why when we take total inventory value, we are taking 4,700 and not as 5,000. Okay, I hope that answers your question, Ma. Right. So we get started with the next standard. Similar to the lines of AS2, AS10, property, plant and equipment. What is AS10 about? It is going to discuss about property, plant and equipment, which was earlier fixed assets. So basically, the nomenclature for fixed assets, tangible fixed assets is property, plant and equipment. What is a PPE? Asset held by the enterprise. Again, 3 points. For use in the production or supply of goods and services, not consumption. For use in the production or supply of goods and services, or to be provided as rental in the course of business, or for any administrative purposes. So 3 points to remember: for use in the production or supply of goods or services, for rental business purposes, or for administrative purposes. An asset should be expected to generate future economic benefits. That is, the usage should cross at least one financial period, 12 months period. So 2 criteria. One, it should meet the 3 points rule, which is use in production, rental or administrative purpose. Second, it should generate future economic benefits, or in other words, the lifetime should exceed at least one financial period. The standard does not cover intangibles, but it covers bearer plants. What are bearer plants? Bearer plants are nothing but any agricultural produce or any agricultural plants or trees that are used for generating agricultural produce. Not crops, trees that are used to generate agricultural produce. Okay, may be asked. If at all asked, please make a note of it. Bearer plants are trees that are used to generate agricultural produce. So this is about what is a PPE. Next, measurement. When should I recognize the cost of PPE in the books? When should I recognize the cost in the books? When the future economic benefits are certain. When there is certainty of future economic benefits. Second, when the cost of the asset can be reliably measured. So when you know that this asset can give future benefits, and when you can measure the cost of the asset, then it shall be recorded in the books as a PPE, as an item of tangible asset. Now again, next question, what is cost? Okay, what is cost? This cost includes purchase cost, non-refundable taxes, cost of subsequent additions, if I am making any additions or increments to the machinery, and if it gives future economic benefits, which means repairs and maintenance and all will not be considered. So cost of subsequent additions, and the keyword here is any costs that are directly attributable to bringing the asset to its current location for its intended use. There are 2 words to remember in PPE. Directly attributable costs, incidental costs. If it is a directly attributable cost, included. If it is incidental cost, excluded. Okay. So directly attributable costs to bring the asset to its current location for its intended use is included. And this includes the cost or initial estimate of dismantling at the time of removing. Dismantling at the time of removal. It includes dismantling costs, estimate of dismantling costs, because there is no actual that will be available. So it includes the estimate of dismantling costs. Now coming to the exclusions. Any costs that are incidental in nature. So what is incidental cost? How to remember incidental cost? How to differentiate in the exam if it is asked? If that cost is required for that asset, in other words, only if that is spent, the asset can be built. Second, this is one point. If I spend this rupees only, I can complete this asset. This is point number 1. Point number 2, whether I am constructing or building this asset or not, is this expense going to be incurred? For example, I am relocating my office premises. Whether I am going to renovate the office or not, I am relocating the premises. Then that is incidental. That is not directly attributable. If I am incurring a specific expense for that asset, then that is directly attributable. If I am going to incur that expense irrespective of that asset, then that is called as incidental cost. Remember this underlying hint for answering your questions. Initial operating losses excluded. Trial run losses, initial losses on operations excluded. Cost of transporting the asset after it is put to use. Remember, when the asset is ready for use or when the asset is put to use, your recognition will stop. After that, everything will be expense. It will not be taken to asset. So in cost, all directly attributable costs are included, incidental costs are excluded. So this is relating to cost. So we have understood 2 points. What is PPE? When I should recognize PPE? What is the cost of recognition of PPE? Next, after recognition, what I need to do? Carrying cost. What is the rule for carrying or measurement after that? 2 rules are available as per AS10. One is called as the cost model and the other is called as the revaluation model. What is cost model? Asset is shown at cost minus depreciation, accumulated depreciation. So asset is carried at cost less accumulated depreciation. What is revaluation model? Asset is revalued at every period or at intervals, say once in 2 years, once in 3 years, depending on the type of asset. There the question of depreciation will not arise. If it is revaluation model, depreciation will not come. So either you follow the depreciation model or you follow the revaluation. Okay, so if the entity follows cost method, cost minus depreciation. If it follows revaluation method, revalued value will be applicable. One point to remember, if one class of item in a group of assets is taken in one method, I should apply for all the items in that group the same method only. So if I apply for one plant and machinery, one item of plant and machinery, if I apply cost method, for all the items in that plant and machinery category, I should apply cost method only. Right? So method should be consistent within the same group of the assets. Methods of depreciation. The standard does not specify any standard method of depreciation. You can go by any method of depreciation as per the prevailing law or as which gives the reasonable estimate or reliable estimate. Depreciation is charged based on the useful life for the entire group of the assets. Okay? Or based on individual components. For example, if this building, if I decide that all furniture fittings, everything is going to come as a part of, integrated as a part of the building, then building as a whole, one item of PPE. One depreciation, the building flat, whatever is the percentage depreciation. Or I can recognize as different parts, building, interiors, furniture and fittings, I can recognize as different parts with different useful lives. So in that case, depreciation will also be different. Whichever method you follow, you need to follow it consistently. Okay, in the question, if they have given different categories and different useful lives, follow different depreciation. If they give only one category and one useful life, follow single depreciation. So single depreciation is like a grouped assets depreciation, or the other one is called as components method or componentization method. Depending on whatever is asked in the question, it will be very clear. On the face, you will see it. If there are multiple assets with different useful life, follow component method. If it is only one asset, one useful life, follow grouped assets method. So this is regarding your cost method, depreciation calculation. Now coming to revaluation. If you are revaluing the asset, okay, if the revaluation is under cost model, then your entry will be very simple. If the asset is increasing, asset account debit to revaluation reserve. Asset account debit to revaluation reserve. If the asset is decreasing, profit and loss account debit to asset account. So remember the rule, an increase is taken to revaluation reserve, a decrease is taken to profit and loss account. Expensed in the same period. Okay, so the rule is in revaluation method, revaluation of assets, increase revaluations will go to revaluation reserve, decreases P&L account. And the last most important point, if there is a change in useful life, if there is a change in cost, if there is a change in method of depreciation, SLM to WDV, WDV to SLM, whatever it is, the change will be given prospectively. What do you mean by prospectively? From the date of change, not from the original date. Okay, so prospectively is from the date of change. No retrospective effect. Okay. So this is AS10 in a nutshell. It will, if you remember the concept of cost, what is included, excluded in cost, how to calculate depreciation, and the point that changes in depreciation useful life will be prospective. 3 points, if you majorly remember, most of AS10 is over. Your questions will be around in and around these areas when you have to, when it is tested. Clear? Quickly run through and then we'll start with the practical questions. Any doubts in AS10? Abhinaya asks, any costs that are incidental in nature? Okay, example. Incidental nature, if you can take examples, is cost of relocation, temporary fittings, cost of temporary fittings. So if I have to temporarily do make a temporary makeshift arrangement for storing the materials, okay, and if it is going to be like until I renovate my building, I am going to shift all my furniture to a separate place. So they are all incidental costs. They are not necessary to bring the building into existence. So they are all incidental costs. I hope it's clear, Abhinaya. Right. Question number 10. A Limited has incurred the following costs. Determine whether the following costs can be added to the invoice purchase price and included in the initial cost of recognition of property, plant and equipment. So we are just going to say whether they are included or excluded. Number 1, import duties paid. Included. Shipping cost and cost of road transport for taking the machinery to the factory. Included. Insurance for shipping. Why? Included, excluded? Okay, answer here is available as included. But why? Insurance is mandatory for shipping and shipping is mandatory to bring the asset to the existing location. No shipper will agree to take the product without insurance. Nowadays, transport insurance is mandatory. Right, so insurance is included as it is directly attributable. Okay. Inauguration costs for the factory, excluded because it is not relevant. This is an example of incidental cost, not relevant to the asset. Professional fees charged by the consulting engineer for installation, directly attributable, included. Cost of advertising and promotional activities, excluded. Administrative and general overheads, excluded. Cost of site preparation, like excavation, clearing the ground, whatever it is. So it is included. Right? So the simple rule is, if it is directly attributable for bringing the asset into its location and present condition, it is included. Incidental costs are excluded. Right? Right, friends? Question number 11. Entity A, sub-question A I am answering now first. Entity A has a policy of not providing depreciation on PPE capitalized in the year until the following year, but provides for full year depreciation in the year of disposal of the asset. Is it acceptable? No. Why?
Because the last one said that there is a change. It should be from the date of change.
Very good. Depreciation has to be provided from the date on which the asset is ready for its use, or from the date on which asset is available for use. And if at all there is a change in the cost of the asset, from the date of change, the revised method will be applicable. So your answer is the depreciable amount of a tangible fixed asset should be allocated on a systematic basis over its useful life. Depreciation should reflect the pattern in which the asset's economic benefits are expected to be consumed. Useful life means the period over which the asset is expected to be available for use. Depreciation should commence as soon as the asset is acquired and available for use. In this whole paragraph, this one line carries the weightage. This is the line which will actually say that you have hit the answer correctly. Okay? So depreciation should commence as soon as the asset is acquired and available for use. Therefore, the policy of entity A is not acceptable. Your starting lines as per AS10, all that will come. Please ensure to quote the name of the standard. Okay? Do not skip that. Next, subdivision B. Entity A purchased an asset on 1st January 2016 for 1 lakh. The asset had an estimated useful life of 10 years and a residual value nil. 1st January 20, the directors review the estimated life and decide that the asset will be probably useful for another 4 years or further 4 years. Calculate the amount of depreciation for each year if the company charges the depreciation on straight line basis. So what is the point that we have to write here? As per AS10, when the value of the asset or when the estimate of useful life is revised, the change shall be given to the depreciation prospectively. Okay, so let's calculate. Let's do the calculation first and then we'll check the answer. Purchase cost is 1 lakh. Okay, and residual value is 10 years. So depreciation up to 2020. 1st Jan 2020. 1/1/20. What will be the depreciation? 16, 17, 18, 19, 20. I think 5 years we need to provide, right? The purchase was on 16. So 16, 17, 18, 19. Sorry, 4 years. We are on 1st Jan 20. So 4 years, which will be 1 lakh divided by 10 years estimated useful life for 4 years, which is 40,000. This is from 2016 to 19. 16, 17, 18, 19. So now, what is the book value as on 1/1/20? One lakh minus 40,000, which is 60,000. Now, the directors review that the estimated useful life will be for a further period of 4 years only. So revised depreciation is going to be 60,000 divided by 4, which is 15,000 per year. 15,000 per year. So I'm reading out the answer. The entity has charged depreciation using straight line method at rupees 10,000 per annum. So on 1st January, the book value will be 60,000. The remaining useful life is 4 years. The company should amend the annual provision for depreciation to charge the unamortized cost over the remaining useful life of 4 years. So the depreciation will be at 15,000 per annum. Depreciation is recognized even if the fair value of the asset exceeds its carrying amount. Repairs and maintenance of an asset do not negate the need to depreciate it. These are additional points only for your reference. But your main answer, if it stops here also, you will be awarded the marks. Right? Is this clear? So the point here is prospective method after change in useful. Question number 12. Omega Limited is contracted with a supplier to purchase machinery which is to be installed in one of the departments in 3 months' time. Special foundations were required to be prepared within this within this supply lead time. The cost of the site preparation and laying foundations was 1,40,000. Activities were supervised by a technician during this period of 3 months. For this purpose, he was employed at 45,000 rupees per month. Purpose of the machine purchased at 158 lakhs and 50,000 transportation charges were incurred to bring the machine to the factory site. Architect was appointed at a fee of 30,000 to supervise the machinery installation. You are required to ascertain the amount at which the machinery should be capitalized as per AS10 and calculate depreciation assuming straight line method at 15 years useful life. Go ahead. You have items as number 1, cost of site preparation. Is it included or excluded? Included. Technician supervision for 45,000 rupees per month. Included because he is required for the installation purpose. Machinery cost 158 lakhs. Included. Transportation cost. Included. Architect's fee for supervising the installation. Included. So go ahead, calculate the cost and calculate the depreciation. Purchase price 158 lakhs. Cost of site preparation 1,40,000. Technician salary 45,000 into 3 for 3 months. So 135,000. Initial delivery cost or transportation cost 50,000. Professional fees for installation or architect's fees 30,000. Total 161,55,000. Depreciation for 15 years, if you put, it is 10,77,000 per year. $10,77,000 per annum. Okay. So this is your AS 10. Shall we move on to the next standard? AS 11. So we have summarized AS 10 till here and we'll start with AS 11. Effects of changes in foreign exchange rates. This standard is in 3 parts. Okay. First part is about foreign currency transactions and restatements. Second part, foreign currency operations, integral, non-integral operations, which you will also be studying under branch accounts as foreign branches. Okay. And third part is relating to forward contracts. So 3 parts of this standard, and all the 3 parts are capable of being tested in your compulsory question. So they can even give you a small foreign branch related trial balance and ask you to calculate foreign currency translation reserve. At branch accounts illa, the AS 11. Okay. So remember your AS questions might look intertwined or might look big sometimes, but they are going to be the most scoring area. So do not skip any part that is relevant to AS while you prepare for your exam. Okay. Starting foreign currency transactions. Every transaction has to be recorded on the date of the transaction at the rate prevailing on such date. So on the date of the transaction, whatever is the rate, the transaction needs to be recorded. Second, at the time of settlement, so which means when you are going to make the payment or receive the payment, so where there is a settlement of a transaction in monetary terms. Settlement rate has to be recorded and the difference will be taken as a gain or loss in profit and loss account immediately. Same financial year, the entire amount of gain or loss shall be recorded. If the transactions are not settled, which means if you have assets or liabilities, the assets or liabilities are going to be classified into 2 parts. Monetary items and non-monetary items. What is a monetary item? A monetary item is any item that results in a monetary inflow or outflow in the future. Or it has to be settled or repaid in the form of cash or cash equivalents in the immediate future, not later. Even share capital is monetary. I have to repay. That is not the consideration. Immediate future, if there is a cash or cash equivalent to be paid or received, then it becomes a monetary item. Non-monetary items, anything other than monetary items becomes a non-monetary item. Now, monetary items will be compulsorily restated at closing rates, which means I need to convert the balances as on the closing date, as on 31st March or December, whichever is the period. And the difference on restatement will be taken to profit and loss account. Non-monetary items, nothing doing, take it at historical cost. Take it at historical cost. So remember the rule, monetary items, restatement is applicable, non-monetary items, nothing is applicable. Subsequently, if there is a settlement, for example, in 2021, I have restated a monetary item. The transaction is settled in 2022. What will be the difference? taken? Is it the difference between the original transaction rate and settlement rate, or is it the difference between restated rate and settlement rate? It is between restated rate and settlement rate. Okay, so if the settlement happens in the subsequent financial year, the difference between settlement rate and closing rate is nothing but your restated rate, has to be taken as the difference for profit and loss account in the year of settlement. One note, very important to make a note of, in case of foreign currency long-term borrowings. Now, you can have two types of borrowings, one for your business, other in specific for your fixed assets. Okay. If the borrowings is long-term borrowings is for fixed assets, then, okay, the entity has the option to take the differences on settlement to, normally where we will take the differences on settlement to P&L account. But here there is an option to either profit and loss account immediately or to foreign currency translation reserve. To foreign currency translation reserve. And amortize the same over useful life of the asset. So instead of taking it to P&L account immediately, I can take it to a separate reserve and keep amortizing from the reserve based on your useful life of the asset. If the asset is for 10 years, I can amortize this over 10 years. This is applicable only for borrowings that is taken for fixed assets or for PPE, not for any other borrowings. Okay. So if the question says that the borrowing was made for asset, then we should write this point, saying the entity has the option either to take it to P&L account immediately or to take it to foreign currency translation reserve. Next. Next we come to the second part, which is foreign currency operations. Two types of operations, integral operations and non-integral operations. What is an integral operation? Integral operation is as if the business or the head office itself is doing the operations or doing the transactions. It will be treated as if the reporting enterprise carried on the activities like its own. Okay. So the difference, any differences arising out of foreign exchange will be taken to profit and loss account. And what is a non-integral operations, my dear friends? Non-integral operation is any operation or any branch or department which acts independently of the enterprise, which has its own decision-making capabilities. A classic example is a foreign branch, which has its own wing of operations, has its own decision-making, has its own independent cash flows. Okay, so a non-integral operation, in that case, what we will do? We will only receive the trial balance. So based on that, we are going to do the calculation. How we are going to do? For all assets and liabilities, closing rate. For non-monetary items, historical rate. Okay, and for, so let me write that also. For non-monetary items, historical rate. Like fixed assets, historical rate. For all other assets and liabilities, closing rate. For profit and loss account, income and expenses related items in the trial balance, average rate, opening plus closing divided by 2. So you will convert the trial balance based on assets, liabilities, closing rates, average rates for income and expenses, and the difference will be taken to foreign currency translation reserve, not to P&L. It has to be maintained under foreign currency translation reserve. We will not be doing a practical question now in this, friends, because I think in branch accounts, sir will be covering as a part of your branch accounts revision. So that portion you've completed. Perfect. So branch accounts, if it is completed, then you would have covered it. So I'm moving on to the next portion. But just remember that branch accounts conversion of trial balance from foreign currency to INR or reporting currency can be a tested area and has been tested under compulsory question for 5 marks or 10 marks depending on the length of the question, right? Third part of the standard, forward contracts. What is a forward contract? It is an agreement that is entered today to exchange foreign currency at a future date. At what rate? At a rate that I agree today for the future. So today itself I am agreeing that I will pay you so and so rupees in this particular date. Whatever may be the currency rate on that date, I don't bother, I will end up paying that rupees if I go with the contract. So a forward contract is an agreement to exchange different currencies at specified exchange rate on a specified future rate, which is called as the forward rate. Okay. Rules to remember for recognizing the contract. When you enter into the forward contract, today rupees is 70 rupees. You are entering into the contract for 72 rupees. The difference between today's rate, which is spot rate, and the forward rate, that difference has to be recognized. So first rule, the transaction is recorded at spot rate, which means when you pass your entry, say for example, purchases. If I am purchasing today at a forward contract, purchases to creditors entry will come under spot rate. So transaction is recognized in spot rate. The difference between spot rate and forward rate is apportioned over the contract period. If the payment has to happen over 3 months, then find the difference 70 minus 72, 2 rupees into whatever is your total purchase. Okay, that difference will be amortized over 3 months contract period. Okay. Suppose in between if I'm cancelling the contract, I'm not going ahead and paying in 3 months. Suddenly I find rupee is doing better. Why should I pay him 72 rupees? So forward contract is cancelled in between. Say in 2 months itself I'm cancelling the contract. Whatever is the remaining portion of gain or loss which you have not recognized yet shall be taken to P&L immediately. Whatever is unamortized, amortize it immediately. Also, if there is any other gain or loss on cancellation, because at the time of cancellation you will have a rate, cancellation spot rate. The difference between the forward contract rate and cancellation rate shall also be recognized in profit and loss account. So two recognition should happen at the time of cancellation. One, unamortized forward contract rate. Second, difference between forward rate and cancellation rate. So two rates we will take at the time of cancellation. So in a forward contract, let us remember the rule again. And the transaction is recorded at spot rate. Difference between spot rate and forward rate is taken to is amortized over the contract period. Third, when you cancel the contract, unamortized gain or loss will also be recorded. The second, the cancellation rate and the forward rate will also be adjusted and the difference is taken to profit and loss account. So 3 parts of this standard: foreign currency transactions, integral non-integral operations and forward contracts. Clear with the standard? Quickly run through for a minute and we'll start with the questions. Question number 13. Your latest RTP question. Kumar Limited borrowed US dollar 3 lakhs on 31/12/2020, which will be repaid as on 36/2021. Kumar Limited prepares its financial statements on 31/3/21. Rate of exchange between the reporting currency and foreign currency, the rates are given as under. As on 31/12, 44 rupees, 31/3, 44.5 and 36, 44.75. Number 1, you're required to calculate the borrowings in reporting currency to be recognized and also show the journal entries. Second, if borrowings was repaid on 28th February, which is before the financial year closure, at 44.2 rupees, then what will be the entry that is passed? So in both cases, we are going to show the journal entries. As per AS 11, effects of changes in foreign exchange rate, a transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency the amount of exchange rate between the currency and foreign currency at the date of the transaction. So in simple words, we can write a foreign currency should be recorded on initial recognition at the rate prevailing on the date of the transaction. Let's write it in simple terms. At each balance sheet date, the monetary item should be reported using closing rate. So accordingly, 31/12 borrowings will be recorded at 3 lakh into 44 rupees because the initial recognition is at 44 rupees. And as on 31/3, borrowings is a monetary item and therefore it will be recorded at closing rate, which is 3 lakh into 44.5 rupees. Okay. At the time of repayment, the difference between 44.75 and 44.5 will be taken for gain or loss calculation. Okay, we should not take 44 and 44.75 because we have already restated it. We will calculate the gain or loss only based on the closing rate. Now to the journal entries. Bank account debit to loan account. 132 lakhs. What is 132 lakhs? 3 lakhs into 44. Right? Bank account debit to loan account 3 lakhs into 44 rupees, 132 lakhs. Next, foreign exchange difference account. Friends, you can use this terminology or you can directly also write it as P&L account, profit and loss account. Okay, not wrong. It is not a wrong way of presentation. So foreign exchange difference account to loan account 1,50,000. Why? Because the loan 44 rupees is now increasing to 44.5. So the difference is 0.5. 0.5 into 3 lakhs will give you 1,50,000. Hence, the loan amount has increased. So, foreign exchange difference account debit to foreign loan account, or profit and loss account debit to foreign loan account. So, this is the end of the financial year. Next year, when the repayment is made.
How is that 1.5 calculated?
Okay, it is based on 3 lakhs, which is the USD, into the difference between restated rate and the opening rate or the transaction rate. So if you look at the closing rate, it is 44.5, which means the value should be 3 lakhs into 44.5. Can you calculate 3 lakhs into 44.5? One lakh 33.50. Whereas you have recorded it only at 1 lakh 32 or 132. So the difference of 150 is recorded as the foreign exchange difference. Now, after the financial year, we are going to do the repayment. Loan account to bank account. Okay, this difference will be adjusted as P&L debit or credit or foreign exchange difference account. Now, loan account is not 132 anymore. Loan account has been restated to 133,50,000 as at the end of the financial year. Whereas I am going to make a payment of 44.75 rupees per dollar. 44.75 rupees per dollar, which gives you 44.75 into 3 lakhs. $134.25. $134.25, correct? And therefore, there is an excess payment which is a loss. The loss will be taken to P&L account, which is nothing but the foreign exchange difference account, 75,000. So I repeat the journal entry for payment. Foreign loan account, debit 133.50. Foreign exchange loan account or P&L account, debit 75. To bank account 134.25. Right? Next part of the question. In case the borrowings was repaid on, reading the question again. In case the borrowings was repaid on 28/2 at rupees 44.2. So there is no restatement that would have happened as on 31st March. So no restatement in that case. Your payment entry will be loan account debit to bank account. Now loan account is not restated. So it will be at the original rate of 132. Okay. And payment was made at 44.20. So 44.20 into 3 lakhs will give you 132.60. And therefore there is a loss of 20 paise into 3 lakh rupees, which is 60,000. 3 lakh dollars, which is 60,000. The only point here that we have to remember is loan account will not be restated because it is before the balance sheet date. So I have also written a note. The foreign exchange difference account is transferred to profit and loss account. So you can also use profit and loss account as the account name itself in the journal entry. Is the question clear? Yes, Pratik, even if there is a gain, it has to be posted in P&L account in the credit side. So let's move on to the next question. Question number 14. Okay. Classify the following items as monetary or non-monetary. Share capital. Share capital is non-monetary because it does not result in immediate or in the immediate future there is no cash or cash equivalent which is to be paid. Non-monetary. Trade receivables. Monetary. Investment in equity shares. Non-monetary. Fixed assets. Non-monetary. Prepaid expenses. Monetary. What is prepaid expenses? Prepaid expenses are those expenses we have already paid. The expense is just going to get amortized in the next future period. You are not going to receive a cash or cash equivalent benefit out of it. So it is non-monetary. Prepaid expenses is non-monetary. Outstanding expenses is monetary because there is a cash or cash equivalent payable. So I'll show you the answers. You can check. I repeat, share capital non-monetary, trade receivables is monetary, investment in equity shares, whether it is current investments, long-term investments, whatever it is non-monetary. Fixed assets, non-monetary. Prepaid expenses, non-monetary. Outstanding expenses, monetary. Yes. Okay, prepaid expenses are expenses which have already been incurred. What is remaining is only the amortization or the benefit that you have to receive, which is not in cash or cash equivalents. Monetary item means the benefit receivable or payable should be in cash or cash equivalents. Here it is not the case, hence it is a non-monetary item. Right? Question number 15. Ax Limited purchased fixed assets costing $5 lakh on 1st Jan 2018 from American company M&M Limited. This amount was payable after 6 months. The company entered into a forward contract on 1st January for 5 months at 62.5 per dollar. The exchange rate per dollar was on 1st January 60.75, on 31st March 63 rupees, which is closing rate is 63 rupees. You are required to state how the profit or loss on forward contract will be recognized in the books of Ax Limited for 17-18 financial year, which is for the financial year or period ended 31st March 2018 as per the provisions of AS 11. What is the rule as per the forward contracts? A forward contract shall be recognized at spot rate. The difference between spot rate and forward rate shall be amortized over the, not the payment period, over the contract period. If you see here, the amount was payable after 6 months. However, the contract period is only for 5 months. So what is the amortization for? The amortization will only be for 5 months and not for 6 months. Let's go ahead and do the calculation. Forward rate 62.5. Spot rate 60.75. Spot rate is the transaction rate and forward rate is the rate of contract. So what is the premium on contract? 1.75. Now, is this premium a gain or a loss? Not always it needs to be a loss. Let's read the question to understand whether it is a gain or a loss. Axe Limited purchased fixed asset. So, is it going to pay currency or receive currency?
Okay.
Am I going to pay? Am I going to pay the person or supplier, or am I going to receive money from them? Pay. So when you are going to pay, you should see whether you are going to pay more as per the forward contract or pay less. Forward rate is 62.5, whereas today's rate is only 60.75. I am going to pay more, so it is a loss. Okay. If the same question was Axe Limited sold fixed asset or sold assets costing, then it would have been a gain. So not necessary that it is always a loss. Read the question to find out whether it is a gain or a loss. Okay. So here, contract value $5 lakh, total loss $5 lakh into 1.75. Therefore, the total loss is 8,75,000. And the contract period is 5 months, not 6 months. Contract period is only for 5 months. Now, the question says the contract was entered on 1st January. We are closing the financial year for the period 31st March. So, Jan, Feb, March, 3 months. Out of the 5 months, 3 months are coming under the financial year 17-18. Therefore, the loss to be recorded for 3 months will be 8,75,000 into 3 by 5. 8,75,000 into 3 by 5. I repeat, the difference between forward rate and spot rate is taken as the loss per rupee, which is 1.75, sorry, per dollar, which is 1.75. Total contract value $5 lakh, and hence the total loss is 8,75,000 for 5 months. Now in this 8,75,000, 3 months is expired in 17-18. So 8,75,000 into 3 by 5 will give you 5,25,000 for the current year. And the balance, which is 875 minus 525, 350 will go to the next financial year 18-19. Right? So this summarizes AS11 and our today's discussion of accounting standards part 1. Tomorrow first half we will take the balance 4 accounting standards. Right? You can take your break for lunch, and after that we will resume with the other topics.